As the world grapples with the aftermath of the pandemic, it's becoming increasingly clear that the once booming restaurant industry is taking a significant hit. With Domino's, one of America's largest restaurant chains, announcing the closure of thousands of stores, it's hard not to feel the panic rising. With the news of thousands of stores being closed, it's time to ask ourselves, what does this mean for the future of our beloved fast food industry? Are we about to witness the collapse of an entire sector that has been a staple in our daily lives for decades? The closure of Domino's stores is just the opening act in this catastrophic retail apocalypse, and it's time to wake up and face the reality of this situation. Please support our channel with a thumbs up and don't forget to subscribe to our channel. Large American restaurant franchises are battling to survive the ongoing economic downturn. Domino's Pizza, which has around 19,000 locations throughout the globe, is also facing difficulties and losses in 2023. Shares of the company have dropped to their lowest level in nearly 10 years, and the chain is now liquidating hundreds of unprofitable stores due to its latest inflationary scandals. The recent numbers suggest that the pizza restaurant is in much greater danger than we had previously realized, and analysts warn that if it doesn't take action to stabilize its finances soon, it might quickly become swamped by its debt and fall prey to the great retail collapse. During a recent announcement, the top officials of Domino's Pizza, U.S. CEO Russell Weiner, and CFO Sandy Brady disclosed that the company is currently experiencing mounting pressure on its domestic delivery business. In fact, they further cautioned that they expect these challenges to exacerbate considerably over the coming months. Given the current state of the economy and with inflation continuing to take its toll on the pockets of the average American, it has become commonplace for households to reduce their discretionary spending drastically. As a result, many customers question the value of the delivery fees levied by their local stores and franchises. This downward trend could seriously impact the bottom line of not just Domino's Pizza, but the entire pizza delivery industry. According to the expert opinion of research analyst Jim Sanderson, Domino's recent difficulties have set off alarms for other large restaurants and fast food chains. The company has encountered significant challenges in its delivery operations, which, combined with ongoing macroeconomic pressures, have resulted in a downward revision of its projected retail sales growth over 2 to 3 years. Specifically, Domino's has moderated its expectations, now anticipating growth between 4% and 8%. A notable deviation from its previous projection of 6% to 10% growth. These developments have set off a warning signal throughout the industry, with other enterprises taking note of the challenges Domino's now faces and reevaluating their growth prospects. For over a decade, Domino's Pizza has experienced a remarkable period of expansion, resulting in an impressive increase in their stores from 10,255 after 2012 to an astounding 18,848 by the end of 2022. The company's incredible growth also noted its leadership in U.S. pizza sales, beginning as early as 2017. As a result of the onset of the pandemic, the pizza industry experienced a surge in consumer demand, leading to a meteoric rise in the company's stock, hitting an unprecedented all-time high of just shy of $565 per share in 2021. Sadly, despite these impressive achievements, the company's fortunes took a severe turn for the worse during the fourth quarter of 2022, when the popular pizza chain's earnings suffered a steep decline. In response to rising expenses for labor and materials, the pizza business, like many others in the United States, began charging higher pricing for its delivered pizzas. According to executives, many former consumers stopped using the food delivery service after a price increase of 11% in October 2022. In general, the chain's prices are still 12% more than before the outbreak, as reported by the food blog Eat This, Not That. Several years ago, Domino's Pizza entered the Italian market and immediately set itself apart from local pizzerias with its unique home delivery service. However, in recent times, the pandemic has brought about a significant shift in consumer behavior. With the growing dependence on and popularity of food delivery giants such as Just Eat and Deliveroo, the need for Domino's delivery service has been perceived as less attractive and necessary. As a result, Domino's has had to reevaluate its strategy and explore new ways of staying relevant in the fiercely competitive food delivery market. The long-lasting effects of the pandemic are a key driver of this shift. During the height of the epidemic, many businesses were forced to close their doors, with certain sectors being struck more severely than others. The hardest hit was the retail and restaurant industries, which depend significantly on customers physically visiting stores and eating in restaurants. Despite the resumption of economic activity, these companies had a tough time recovering from rising prices and falling demand. Earlier this year, a company official lamented a 4% drop in European sales and said that the company's strategies, including price hikes, new levies for expedited shipping, and other surcharges, had negatively affected the number of times consumers placed orders. According to Omkar Joshi, Chief Investment Officer of Opal Capital Management, the company lost money due to price irregularities. According to Joshi, during the last year, Domino's has shown to be more fragile than experts predicted. They're starting in a more challenging climate than they did last year, and they're already in a difficult situation. Additionally, it seems that Domino's was unsuccessful in selling pizzas to Italians. The Italian franchisee of Domino's Pizza has declared bankruptcy. According to the company's bankruptcy request, Domino's stores can't survive because the growing number of competing delivery services ate into their profits. According to professionals in the field, the business failed to account for shifting consumer purchasing habits and the impact of rivals' price hikes. Hence, its pricing approach was inefficient. According to a recent study, declining sales were felt nationwide as consumers were unsatisfied with the new costs. One possible cause for the issue facing Domino's is the slight but noticeable price hike for some of its most special deals. Specifically, the Mix and Match deal, priced at a modest $5.99, has been elevated to $6.99 since the onset of December. Another contributing factor entails the strategic adjustments made to the much sought-after carryout deal that originally featured a pizza dip and bread combo or wings priced at $7.99. They didn't increase the deal's cost, but cut the number of wings included in the package from 10 to 8. In addition, consumers may no longer buy 3 toppings on a pizza as a component of the carryout deal. Instead, they are limited to ordering just 1. The retailer has placed even more restrictions on this offer by making it a digital-only promotion, making in-store and telephone orders ineligible. Dissatisfied customers can now spend less on their top-of-the-line frozen pizza than they would on a pan pizza from Domino's. Despite being an established name in the American pizza industry, recent data shows that the chain is witnessing a steady decline in its market share over the last 6 months. In contrast, its competitors such as Pizza Hut and Papa John's have been thriving in the market thanks to their innovative menu offerings and third-party delivery services. However, it appears that the company is unwilling to embrace the current market trends, resulting in them underperforming consistently. With the competition getting stronger by the day and capturing a higher market share, Domino's is on the verge of being pushed to the brink. Domino's has faced major obstacles with its delivery services, directly impacting its profits. The pizza giant, headquartered in Michigan, has suffered from a dire shortage of delivery drivers. The company's employees have been demanding better wages and improved work conditions, contributing to the difficulty in recruiting new drivers. In fact, it seems that many individuals have lost interest in delivery services altogether, fueling an unprecedented shift within the current U.S. labor market. Despite the trend, Domino's has yet to partner with renowned third-party delivery options such as Grubhub or DoorDash. Unfortunately, this reluctancy has caused the brand to lose valuable customers to its rivals. Domino's delivery problems have weighed heavily on their bottom line and urgently require rectification. Taking into account the current state of Domino's financial affairs, the company must devise more effective strategies to rectify its debt burden and profitability concerns. Even as the largest pizza chain in the world, Domino's is not invincible and is susceptible to the repercussions of economic downturns and recessions. Failure to implement innovative measures could prove detrimental to the company's longevity, especially considering the threat of the ongoing U.S. retail apocalypse that has already claimed numerous businesses struggling to stand out in the saturated market. Therefore, Domino's must act swiftly to reinvent itself and employ cutting-edge tactics that will enable it to remain competitive and secure a stable financial future. Thanks for watching. Please like, subscribe, and comment below, and watch this one as well.